So today I had a unique and unfortunate meeting with one of my clients. She has been in an income-driven repayment plan for the last couple of years. We were tracking everything as expected, payments increasing as income has increased over time. However, here recently she has had a disability event and she's out on long-term disability. Now, it reminded me of the importance of any financial advisor that's giving advice to somebody with student loans, specifically those that are in income-driven repayment plans, to consider what is going to happen or could happen if a client becomes disabled. So one of the reasons why we would really want to think long and hard about private refinance is the consumer protections that are available to borrowers if they have permanent and complete disability and the discharge of student debt for that with federal loans. And giving up those protections if we do a private refinance. In the case of this client, though, her circumstances are not that dire. She's out on disability, but it's not permanent and complete disability, so we're not looking at discharge. But she is receiving disability income now instead of working. And interestingly enough, she has just recently contacted her loan servicer about this, and the loan servicer has stated that she needs to provide the disability stubs or income stubs in order for the calculation or recalculation of her income-driven repayment plan. So when she came in and met with me today, we looked at her disability pay, and she's receiving this disability pay tax-free. So it's interesting that how she purchased her disability would impact not just the cost of, from a taxation standpoint, how she's earning her income, but also what is required for her student loans. And what was also interesting is by contacting her loan servicer, she was given incorrect advice as to whether or not she should or was required to provide that tax-free income, as the payments in the income-driven repayment plans are only supposed to be inclusive of federal taxable income. So in her case, if she didn't meet with a knowledgeable financial advisor that understood student loans, she would be in a position where she would be paying an amount to her student loans that, quite frankly, right now she shouldn't and can't really afford to be paying. So luckily we were able to catch this and get her on the right track. But I thought that this was just a small component of the overall process of student loans that really highlights how student loans affects other aspects of insurance and financial planning, and also the importance of being an advisor that's giving advice to clients that knows the rules and regulations, because left to their own vices, most of these clients will end up paying more than they would have, or in her case, she probably likely would end up defaulting on these payments because she simply couldn't afford to make the payments now.